Welcome back to another episode of Divorce at Altitude. This is Ryan Kalamaya. This week, we're going to be talking about the double dip. Amy, when I mention the double dip, what am I talking about?
Uh, Talking about essentially, like, I'll say funds that are used, dollars that are used in evaluation of a business. So, like in property, but then are also then used to calculate support. So that's what we're talking about.
Indeed, and Colorado is unique in how we view or don't view, or in my view, ignore the double dip. And so it relates to business valuations as well as support, whether that be child support or spousal maintenance. And so, Amy, for listeners who don't really understand that, where's the first kind of issue or thing that comes up with the business valuation component with the double dip?
Yeah. So the first thing we look at is really personal goodwill. So I know, Ryan, you've had several cases recently looking at this. Can you explain the difference of the definition for personal goodwill versus enterprise goodwill?
Yeah, the we had an episode with Raj on intangible assets where we got into personal goodwill. I think the easiest people for the kind of example that people can understand is personal goodwill is the value of the business owner compared to enterprise goodwill, which is the value of the brand. So certainly Apple is a company that everyone knows. People would line up in overnight to get an iPhone. And that's because they've got that little Apple sticker. Amy, it used to be like, especially in like Boulder, you would see these Apple stickers, these people that were just super Apple geeks and geeks. That is the brand. Now, there's also Steve Jobs, and everyone knows Steve Jobs. And there are definitely people that would go to buy an Apple product because Steve Jobs. Right now, we've got an interesting political climate where Elon Musk is a super polarizing figure. And there was an article in the paper where the deliveries or the orders for Teslas, they've declined. And it's because of Elon Musk. So Elon Musk has the personal goodwill and it's his impact. And that's separate from the brand. So the personal goodwill, it's tied to, in essence, the business owner or a particular individual's reputation, relationships, and skills. And it can't be sold or transferred separately from the business. Now, Colorado, we include personal goodwill in the value of the business. And there was this excellent article in the Family Advocates, the American Bar Association's publication on for family law, and there was an article and it has it discusses personal goodwill and whether it is included as a marital asset. So Colorado is in the minority in terms of whether we include it. So Arizona, Michigan, Montana, Nebraska, Ohio, Michigan, or Washington, those states, including Colorado again, they include personal goodwill. Now, that is in contrast to Connecticut, Minnesota, Oregon, Georgia, Illinois. There are states that explicitly exclude personal goodwill. We'll talk about how you calculate personal goodwill. Now, there are, then there's a third category or grouping of states where it's like the Facebook relationship status that people will remember, where it's complicated. And the relationship status with personal goodwill and California, Idaho, Tennessee, Wisconsin, it's complicated. So sometimes it is included, sometimes it's not. Let's talk about what enterprise goodwill is. And I gave an example with Tesla and Apple, but enterprise goodwill is the value of the business that can be transferred or sold. So if you're going to buy Apple stock, then you are buying, in essence, the brand, whether Steve Jobs or Tim Cook or whoever the CEO is, you're buying the goodwill of the business. And that is something that people really should understand, is that difference between personal goodwill and enterprise goodwill. How this comes up is personal goodwill is it is the bulk of the intangible assets of Goodwill. And I guess to take a step back, and this is what Raj and I talked about in our episode on intangible, is every business will have some tangible goodwill, or I'm sorry, tangible assets. That's going to be the cash in the bank. It's going to be real estate, trucks, equipment, computers. That is the physical assets of the business. When we talk about goodwill, whether it be personal or enterprise goodwill, it is the value of the business above and beyond those physical assets. So anything that you have money in the bank, and of course, you're going to net that out and reduce it by any sort of debt or obligations that are owed. But anything above that is goodwill. And when you are evaluating a business in terms of personal goodwill, you're really talking about lawyers, real estate brokers, accountants, doctors. Those are professional practices where there is we're really focused on personal goodwill. Anything you want to add to that, Amy?
Yeah, when I think of Goodwill, where I think it makes a huge difference is in those like professional service businesses. That's exactly what I think. For
Yeah,
Kingdom,
indeed. And so when we're evaluating the personal goodwill, and we'll talk about the excess earnings method. It's a manner or a method that it's an income approach that business valuation experts use. But really the things that are going to be determinative of a personal goodwill, and there was a California case that kind of really outlined this, and it's going to be the age and health of the individual, the business owner, the individual's demonstrated earning power, their reputation in the community for judgment, skill, and knowledge, the comparative practical or professional success. Have they won awards? What kind of earning capacity have they had? And then really you're getting into the nature and duration of the professional's practice as a sole proprietor or as a contributing member of a partnership or professional corporation. So there's going to be different methods or different ways that we're going to view professional or personal goodwill. A doctor is going to be different than a real estate broker, and how we view lawyers and the kind of professionals. People come to professional practices. Certainly, Amy, some people, Kalamaya Gosha, and they're like, I want Amy Gosha. They've heard you and they're coming for you. And likewise, there's people that come because they've heard my name. And that is really the professional or the personal goodwill. And the excess earnings method is how we really value the amount of that personal goodwill.
yeah, we went over some of those factors, but just to give people an idea, like if they were having their business valued and it was professional services, what types of like documentation would the valuator be looking for?
Yeah, so almost always we're bringing in experts, so valuation experts, and generally speaking, they're going to use the excess earnings method. And so the excess earnings method is going to, and I'll answer the documentation, but I think it's helpful for people to understand what it is that the valuation expert's doing. Is really the valuation expert's going to start with the company's normalized earnings. So these are earnings of the business adjusted to remove non-reoccurring, non-operating, or owner-specific perks. So the valuation expert is going to look at the profit and loss statements, the balance sheets, bank statements, credit card statements, tax returns, really, and to understand, is this business, does it go up and down? Is it trending up? Is it earning more money? But also to really understand what are the kind of perks or other things that someone may have. Certainly, we've seen professional practices where they have a snowmobile, or they go out and they expense that to the business, or they have a country club membership and they expense that to the business. If a neutral third party is going to come in and buy that business, well, they don't need the snowmobile. They don't need the country club membership. Every business, there is some personal expense, gas or telephone. A lot of people will drive, for example, like up here in the mountains. If I expense all of my gas and transportation. If I go down to the Broncos game, I might see a client and might expense that. But is there some element of personal benefit to that that another owner wouldn't really need? Absolutely. So the evaluation expert's going to add that back in.
Yeah.
Then,
Oh,
yeah, go
sorry.
ahead, Amy.
People like so essentially you'll see your profit and loss statement or your balance sheet, and the expert will come in and you'll see the adjustments that are made where they're taking out the personal expenses. So that's what Ryan is talking about.
Yeah, and we can argue about how much, if any, and it really depends on the adjustments. So if there was an event 2 years ago, you were talking about some sort of event planning business. If there was some huge event a year ago, is that going to be informative of what's going to happen in the future? You could add that back in, or you could exclude it. Those are the sorts of things. Real estate brokers, we can talk about what the impact of COVID was on real estate. Everyone generally knows that real estate went through the roof in 2020 and 2021. And there were a ton of deals, especially up in the mountains. People were going back and forth, and people that were selling real estate, they made a lot of money in 2020 and 2021. Mortgage brokers, everyone affiliated with those years. Now, do you include those or do you exclude them? And so that's really what you're getting at in terms of normalized earnings. Then the second step that these valuation experts are going to do is they're going to deduct a fair return on the tangible assets. So if a real estate broker has money left over from the go-go years of 2020 and 2021, and they've got $2 million in the bank, what's a return of investment? They could have had that in a money market account and generated money or a return on investment. Same thing with equipment or other things. And so what the valuation expert is going to deduct a fair return on those tangible assets. So there is going to be some element of what the company owns, but really what we have remaining is going to be the excess earnings. And the valuation expert is going to focus on what does a normal lawyer make? What does a normal real estate broker make? What the premium or the addition or the delta on what the business owner that we're evaluating, what they earn, that's the value. So it's, you just get paid. If you were a normal lawyer and you are paid a particular amount to go work at a firm, but you make 2x that, that difference is the value, the personal goodwill that you have. And so what they do, the valuation expert, is they then apply a multiple and they multiply that out. So what we're really talking about is if a normal lawyer is, or a doctor, for example, if the normal compensation or salary is, let's say, $400,000 for a doctor, if Eric Wolf is a doctor who makes $800,000, then the kind of excess earnings is going to be $400,000. And then it's going to be that they're going to apply a multiple. And, there's a case that we'll talk about in terms of intermarriage of Huff in Colorado, but there was a multiple of 3. So that you took 3 times 400,000. That means that the business is worth $1.2 million. So you are applying a multiple, and in essence, you're predicting the future excess earnings for that particular professional. And that's how we are measuring personal goodwill, is you're applying a multiple to a revenue stream over time.
Yeah. And so the business valuator will interview the like CEO or the doctor or the lawyer, but they'll also do research to figure out like what if we replaced this doctor, would their salary be the same or would it be less? That's what Ryan is talking about when it comes to the multiple as well.
And then if we take that $1.2 million for, let's say it's a dentist, the value, the personal goodwill of the dental practice is $1.2 million. Then you add the money in the bank and you have all of that, and that's going to result in, let's say, $2 million. Then Eric Wolf's a dentist, the value of his goodwill is $1.2 million. Then Melanie Wolf what is she gonna do, Amy, when she gets half of the $1.2 million for those future earnings? What is she going to ask for undoubtedly after we divide the property?
She's going to be asking for support as well. So how does that affect? Can you explain what is happening in courts now with like personal will or personal goodwill is being dealt with in the business valuation? How is it also being looked at in income?
So the double dip refers to you take that $1.2 million for Eric Wolf's dental practice, which again is based on him earning $400,000 more than the normal dentist over the next 3 years. And so in essence, you're using his income for future years to determine the value of the business. And Melanie, she gets a share of that. And let's just assume that she gets 50%. So you're counting that once. She gets the value of the dental practice, which is based on his future income. But then she's also going to turn around and say, Eric, you make $800,000, and that is the income that you generate, and we're going to use for the determination of whether it be child support or spousal maintenance. And so again, you got $400,000 of reasonable compensation, what a normal business owner or what a normal dentist makes. But then you got another $400,000 for what was included in the value of the business. And Melanie is going to say it should be the $800,000. You use, of course, she wants the highest amount. And there's a case in Colorado, intermarriage of Huff. It was a 2016 case. And in essence, it says that is not a double dip. So it is totally fair for Melanie to argue or to basically claim that the entire $800,000 should be used support. And really, the case says, in that case, the valuation experts, at least the court interpreted what the experts said was that they did not, the excess earnings method was not including future income. And that there wasn't this risk of double dip because the valuation that was performed was not based on future income. Most valuation experts that I interact with, they will admit excess earnings, the way when you capitalize excess earnings, you are including future income. It may not be with other income approaches, but certainly with the excess earnings method, it is absolutely based on future income. But in Colorado, the law is that we're not double dipping. I had a recent case where this issue came up. New York, for example, there's specific case law identifying the risk of including personal goodwill, which is based on future income, as well as the double dip in including that income for spousal support. But the law in Colorado is intermarriage of Huff. I think fundamentally it makes sense to people. It's not fair for Eric to pay the value of the business that's based on his future income and then again pay for support based on that. But we have the law, and it really is going to drive how cases are settled and negotiated and ultimately litigated.
What are, Ryan, some possible solutions? Because it does, to me, seem we've had this discussion like an unfair result. So, what are some possible solutions moving forward?
Yeah, I think possible solutions are first, we've talked about in previous cases about the value of property and how you really look at the value of property before you really talk about the support obligations. And Melanie is going to have some money that she is going to get for the value of the business. Can the court really look at, listen, you're getting the value of the business, and maintenance is discretionary in terms of the court really does have wide latitude in terms of sitting in equity to fashion rulings. And if they understand that concept, then they can take it into account. I think that another strategy or thing that someone can really take into consideration is that, is it fair to do that $400,000, the kind of underlying the support obligation? Because when you have reasonable compensation, and we've talked about this in previous episodes with business valuations, people can, business valuation expert, what they do in terms of evaluating Eric Wolf and like his dentistry practice and whether or not there's reasonable compensation, the higher his reasonable compensation, the less value the business is worth because there's less profits. And so that excess earnings is less. So if the business is generating, same example, $800,000, and if instead of $400,000, we say, geez, dentistry, it's in high demand. The salary for what he does is actually $600,000. All of a sudden, you've taken that income stream that's being capitalized and it's reduced down to $200,000. Is it fair to take the 600,000 or 400,000, the reasonable compensation? Is it fair to use that as the basis for income in determining support? I think that certainly makes sense. The other aspect that you get into is if you're taking a capitalization rate of, let's say, 3, really what you're doing is 3 years. But if we have a maintenance situation, a long-term marriage of 20 years, Melanie is really getting 3 years of future income, but the maintenance guidelines would suggest she's looking at 10 years of maintenance. So she's getting a portion of that future maintenance and future income stream, but she's not getting all of it. So would it be fair to reduce that for the 3 years and then reevaluate, or do you take an average? There's certainly different approaches that you can have to avoid or mitigate the double dip issue. But I think really what I would love to see is a case that goes up on appeal where this is reevaluated. And quite frankly, I think I wasn't involved in the marriage of Huff. I posted about this on LinkedIn and there was several comments. And there was one that just said point blank, this is wrong. And if you look at other states and how they approach it, New York, I mentioned previously, other states, I think it really bears further examination, but I wasn't involved in Huff. I can only read the opinion. I think that certainly if valuation experts are going to be candid and honest and say, I used the excess earnings method and the excess earnings method that I used was future income, then a judge can say, okay, I heard the expert say that they're using future income. That is different than what the assumption was in Huff, because Huff really is clear that there was not a risk of double dip because they were not using future income, and you can distinguish that. And so really, I think having attorneys and experts work together to make sure that is crystal clear. I had a case recently where the expert literally had a table of future income. And so it said in 2025 and 2026 and 2027, this was the kind of the expected amount for the business. And so that is distinguishable when we say, listen, like, this Huff case, I don't really like it, or I don't really understand it, but you don't have to ask a trial court judge to overturn the Colorado Supreme Court, even if they disagree with it. You can ask them to say, or basically find, hey, this actually doesn't apply to me because this is distinct. I did not have a professional, in Huff, it was a lawyer, but I didn't have a lawyer who the valuation expert said, I'm just taking a present value and there's no risk of kind of including the future income. So that's just one final thing, but I'd love to see something go up on appeal. I've talked with other attorneys on it, and I really do think it's worth evaluating.
Very helpful.
And I think the final thing is that we'll add or finish up with, there are factors or items to consider for personal goodwill, because one thing, Amy, you and I have talked about is experts, they're expensive. And so is there really a significant amount of personal goodwill? And those are some of the hardest cases, I think, to navigate, where, okay, a real estate broker or a dentist or a lawyer or a CPA, they might make a little bit more than average. And especially up here in the mountains, the income is higher, but also the cost of living is higher. So do you take that into account? But I think that for people, the attorneys and people, Eric and Melanie, if they're going through a divorce, I think there's a couple factors that consider of whether or not there really is a significant amount of goodwill. And so one would be whether the customers interact with the owner personally. If they do, then that suggests that there is some material amount or there is some personal goodwill. It's the other question might be whether the small business is highly dependent on the owner's skill or skills and personal relationships. Another factor is whether the owner has a non-compete or an employment agreement if they are going to sell the company. Does the owner dedicate many working hours at the business? If they're off in Costa Rica on the beach all the time, then and the business kind of continues to plug along, then that suggests that there's more enterprise value than really personal goodwill. Whether the financing for the business is based on the owner's finances and are there personal guarantees? If so, then you're probably looking at some personal goodwill. The customer's decision to buy or use the business is due to the influence of the owner. If yes, and basically any of these factors, if the answer is yes, then that suggests personal goodwill. Clients come due to the reputation and quality of work of the owner. Another factor is the business owner well known in the industry and community where the business operates. Do they have a podcast? It is another factor is that does the owner, if the owner left the business, would the sales of the business decline? And then finally, is the company's name in the name of the owner? People listening to this, there is definitely personal goodwill for you and for me. And we have some personal goodwill, but there's also some enterprise value. There's people that will come to Kalamaya Gosha for criminal defense or personal injury because they like our logo or they've just generally heard, hey, this is a good firm. And they don't really care who it is. They just trust that whoever works with us or works for Kalamaya Gosha rather is going to be really good at what they do. And so I think people need to understand that and take a step back and evaluate the aspects involved with their divorce. And if there's personal goodwill, then they need to be aware of the double dip because it's going to potentially come up in child support and or spousal maintenance. We'll wrap up. Hopefully this episode's been useful. If it has, please give us a like on social media or wherever you may be listening to this episode. And until next time, thanks for joining us on Divorce at Altitude. Thanks for listening or watching this short lesson on the Divorce at Altitude podcast. If you found this helpful, please leave a review or share with a friend. It does help for others that are going through or thinking about a divorce in Colorado. If you want to find out more information, please visit kalamaya.law or divorceataltitude.com. And that's KALAMAYA.law. Remember, this is educational information. It's not intended to be legal advice. Please consult with an attorney about the particulars of your case. We're happy to answer questions. Feel free to give us a call at 970-315-2365.